Okay, the Fed is expected to announce further steps to get banks to lend this week, and my next guest wonders, where is the need? Chris Rupkey is the chief financial economist at Bank of Tokyo-Mitsubishi, and also, of course, Jim staying with us through this next half hour. And Chris, I mean, you have said basically that, the Fed should be patient. They shouldn't be embarking on QE2.
Well, I think when they started to make the move towards that, the economy was quite weak in the middle of August. Unemployment claims were nearing a double-dip level, above 500,000.
This was back in
Durable
August.
goods report fell 8%. It looked like the sky could have been falling, and that's why they started making the move towards this. At the moment, it doesn't seem to be quite necessary. Jobs are being created. There is some impatience on the part of the Fed. They're missing on both their mandates, but I think things are probably better than we think, and if you wait a couple months, I think we'll see that
it'll
in the
show
data.
That it's not necessary.
Either this Friday or December 3, the next two payroll reports one of them should be better than expected.
And Jim, I mean, you're a proponent of it.
Yeah, I am, Betty, but here again, it's a double-edged sword. I somewhat agree. I'm a proponent on it if, in fact, we could see some form of fiscal stimulus along with it, which the Republicans have vocally indicated that that's not likely to happen.
It ain't going to happen.
Not likely to happen. But I think
so even though you keep saying that, you know it's not going to happen, so are you still a proponent of QE2 then? Well, knowing that that's not going to happen.
I'll tell you what I'm a proponent of, and I'd love your reaction to this, and that is that the Fed signals a willingness to do something in terms of QE2, but not necessarily locking themselves into a dollar amount. That they signal that they will be accommodative, that they will be involved in sort of quantitative easing, but leaving themselves open.
I think anything's possible. I mean, they'll be given a list by the staff of various options. I think the most likely is $500 billion over 6 months. They've been pulling the dealers. The first one they did November 2008 was $600 billion, so somewhere in there. But they'll couch it in terms of up to that amount. They may not get it all off.
But what's the downside risk, though, Chris?
Not a lot. I mean, I'm not a big proponent of. Right? I mean, there's various people in the market saying 30-year yields are up. They're looking for the day where inflation goes to 6% or something because of this quantity easing. But I'm not a big believer in that.
What do you think? Why do you think the dollar has reacted so violently since this?
Well, it's like an ease. They're moving towards easing, quantitative easing. It's the same as cutting rates, and that weakens the dollar, which is a good thing. I mean, it helps our exports. It's probably helping the stock market. Actually, all this move, I mean, I can't really fault it. I don't think it was really necessary, but it did seem to bring up stocks about 1,000 points. I mean, you can't argue with that.
No, but I mean, but the point of all of this is to get lending, to get banks lending. Jim, is it going to get banks lending?
I don't think that's been the major issue with banks lending. I think banks are flush with cash. I think we already know they're flush with cash.
But they're not lending it, though.
Well, it's a question of whether there's big demand for it, and I think that's that's been a debate for several months.
Okay.
Is business actually reaching out to get money from banks when they're not seeing demand from consumers to actually expand and do anything? That to me is the conundrum, and that is money's there. Certainly the bank lending standards has gone up, there's no doubt about it, but I don't think there's a strong demand from business for bank loans.
Okay. All right, we're going to have to leave it here, guys, but thanks so much.